Good afternoon and welcome back to the latest edition of the InvestTalk Market Analysis for the week ending January 12th, 2024. Thank you all for tuning in, liking, and subscribing to this channel as well as our podcast, InvestTalk. I'm host Justin Klein, and this week I'm going to title the video. I have a title here. The U.S. debt situation gets worse, but that's bullish for now. And I wanted to highlight this because usually we go over the broader economy, but this is kind of the bigger picture. And I don't think on these videos I talk enough about the bigger picture, and so that's what I kind of want to do here. Now, this came out this week, and this is the budget for the first fiscal quarter of 2024. I don't know if you know this, but the U.S. fiscal budget actually ends at the end of the third quarter. So the first quarter of say the next year actually starts in the fourth quarter of the previous year. So if you say Q1 of 2024, they're actually for the U.S. budget, it's actually talking about the October through December period of 2023. Now, what did that tell us? What did that tell us? Well, pretty clear. It told us that the budget deficit is accelerating. In fact, the federal budget deficit totaled $509 billion. $509 billion. That's what this is right here. 509 preliminary fiscal year 2024. And what that's showing is that it's accelerating from 421 billion, excuse me. And this is all not just because of revenues dropping. In fact, revenues increased 8%. Right? Look at receipts from $1.26 trillion to 1.1 trillion. But outlays, spending increased 12% to $1.6 trillion. That's just in one quarter. So on an annualized basis, you're talking about a $2.2 trillion deficit. That's 7.5% of GDP. And the cost of servicing that debt is now 16% of all federal tax proceeds. Interest on the debt. And that's what you can see here. And look at what the outlays are. Mainly, you focus on the green. That was 2023, October through September. Full year, HHS, this is basically Social Security. You're talking about 1.7 trillion. Sorry, not Social Security, Medicare. 1.7 trillion. Social Security, nearly a little over 1.4 trillion. Treasury, interest on the debt, now over $1 trillion, about 1.1 trillion. And then defense, just shy of 800 billion. That's where most of the spending's happening. Both parties are going to squabble over all of this here on the right, but it's nothing. It's next to nothing, right? Compared to you add all of this up and it doesn't even come close to our defense budget. So the issue is not around the margins. It's these big items. And it's mainly entitlements. I'll show you this graph first. And this is scheduled to continue to go higher, even if you kept defense static and cut it, because this is as a percentage of GDP, because you would have to cut this to keep defense as a static, about 3% of GDP. You'd actually have to continue to cut it, which is not happening, right? It continues to kind of go up about with GDP. In fact, it's gone down as a percentage of GDP recently, luckily. But that's not really the driver. You can talk about defense spending, and you can argue defense spending could go down. But neither side is talking about this, Social Security and health care entitlements, Social Security and Medicare, Medicaid. This is ballooning. And it's not talking about the interest on the debt either, which continues to go up, right? As all these other things go up. So what's happening here is off balance sheet. These are all what are called off balance sheet liabilities. These are promises to pay Social Security, pay Medicare. And that is ramping up mainly because the baby boomers are retiring, no longer paying into the tax system. And now they're collecting Social Security and Medicare. So that's what needs to change if you're going to change anything. Now, who's buying our debt? This is a great chart because what it focuses on is who the buyers. 2011 over here, we had about $10 trillion in debt. Think about that. Post-financial crisis, we're still only about 10 trillion. And international lenders continue to increase their buying up until about 2020 when COVID hit. And they've increased it modestly, but who's been the biggest holder of our debt? Federal Reserve, right, doing QE. Now they're rolling that off and shrinking that a little bit, but still they're a huge part of financing. And remember, this is going up. So are other lenders, other international lenders, Japan, going to increase? Japan has their own issues. China is letting basically treasuries roll off. They're buying gold and other assets. So it's going to be about domestic lenders basically forcing banks, and you saw what happened with the banking crisis in the spring, holding too many treasuries. And that's part of what the BTFP is, to help them keep buying treasuries and not worry about the risk, the duration risk. And so who's left to pick up the bag if it's not banks? It's also the Fed. And this is why the Fed is talking about pivoting. That's why if you look at the projections, what they're talking about for this year is 3 cuts and winding down QT, meaning, hey, see this 5.4 trillion? Right now it's shrinking. Are they going to continue to shrink that? No, they're saying we're going to stop that. And mainly that's because of this. They have to, right? There's just too much debt, new debt being issued. And so that's why, and so, the only other option, right? Look, if you go back to here, talking about Social Security, entitlements, health entitlements, and defense, those things aren't changing. What can they impact? Well, what they can impact is this, the Treasury. This is interest on the debt. So if they cut rates, they've been raising rates, so they cut rates, that's going to help the budget deficit. And so I think that's why the market is saying, yeah, they're going to cut more. Because if you go back all the way up to December of this year, the market is pricing in going from 425 all the way to 350. That's 175 basis points of cuts. That's 7 rate cuts is their base case. And part of that is the economic trajectory, mainly inflation, but also this debt situation. Now let's talk about the inflation situation. There's some data this week. That was mainly what economic data that you can point to. CPI month over month accelerated actually a little bit, but market kind of shrugged it off because the core, that's core CPI, core PPI, that was on Friday, that was actually in negative territory. So that was generally a positive. So I wanted to highlight that because, and I say that's bullish because the Fed is recognizing this, I think. And this is ultimately going to mean a weaker dollar. And this is why you can ignore this little split here, but basically this is flat, so this is just a bearish consolidation, probably for a move lower. Okay. You can see that with the XLE. This continues to go higher. The euro continues to move higher in general versus the dollar. Same with other currencies. FXY, the yen getting some strength here. Because it's pretty clear that the high interest rates, the 10-year at 4, the short-term rates at 5, that's going to have to come down and likely to come down this year. And so that's why I think the dollar will continue to be weak. And ultimately, that is positive for risk assets. So I really wanted to highlight that because you kind of have to be bullish in that scenario. A weaker dollar, more government spending. We talked about how outlays are up 12%. Remember, how do you calculate CPI? CIGX. That's the calculation. Let's pull that up here. Pull this up here. CGIX GDP. That's what you learn in all together now. CIG and then X. This is net exports. It's this right here. This is the first thing you learn in basic economics class. This is my first class, one of my first classes in college. was macroeconomics. How do you calculate GDP? And C is consumer, right? Total spending by consumer. Total investment is I, spending on goods and services by businesses. And then G is total spending by government. And the government is spending a ton of money. And everyone's going to blame the one side or the other. Oh, they want to spend money on this, or there's tax cuts, etc. But it's about the entitlements, people. That is the problem. Look at this. What went up from 2022 to 2023? HHS, Medicare, Social Security, and defense went up as well. VA also went up a little bit. But most of these other things went down. And if they went up, it's minor. It's a 50 billion here, 20 billion there. That's not the issue. It's Social Security went up nearly $200 billion in 1 year. Medicare went up over $100 billion. So that is the problem. Sorry, actually, this isn't 1 year. This is 1 quarter, right? This is looking at year over year, October through September, year over year. These are 1 quarter you're talking about. So I wanted to highlight that because it's so important to understand these dynamics. That as long as the government is spending and the Treasury and the Fed are there to kind of create an alphabet soup of things, right? Of programs that keep the system together, that likely means higher asset prices, weaker dollar, and inflation. Now, I do think near term, I look at the PPI number, going back to that. This is, I think I closed it. Oh, it's back here. There you go. This pretends to weaker inflation going forward. This will be something I'll be watching, see if this reaccelerates. So near term, I do think you'll see the runway for the Fed to continue to probably cut, because they need to. And if inflation remains subdued, like it has over the past 6 months, then that's going to give room for them to ease policy. And that's positive for risk assets. And you look at the credit markets. While we had a pullback to start the year, what did they do this week? Rebounded. This is short-term junk to short-term treasury. So this remains in an uptrend. Nothing to worry about really there. Okay. Let's see. What do I get to? Let's look at the MOVE index kind of as we transition from that. And this is the volatility of the treasury market. And that continues to be subdued. Why? Because the Fed continues to give room for this for them to ease, and therefore the treasury market to remain stable. So no real red flags there. Now the VIX did get a bump up, but still remains kind of subdued. Now my base case is I think we stay relatively positive for most of the first quarter. And then as we get into the late first quarter, second quarter, that's where I think you can get a market pullback. Now we are nearing all-time highs. And typically, markets don't break through the first time. They chop sideways, maybe you get a pullback, and then I think you get a breakout. And I think most of this year is positive but choppy. After the election, into the election, I could see some changes. But ultimately, you have to be positive for risk assets. Now, one thing I want to highlight was the gold market. Gold on Friday moved up nicely. We had the problems in the Middle East. Geopolitical tensions continue to rise with what happened with the Houthis. And that's going to give an underpinning for gold, as well as if the dollar continues to weaken, especially against the yen. That's usually a good proxy for what happens with the gold. So that remains strong. Now, the silver to gold ratio, that's one that kind of worries me. This has to get some traction to the upside. So I'll be watching that. That continues to be not breaking down, but not breaking out either. Now, earnings season is kicking off. We had the banks come out on Friday. They were kind of mixed. Not great, to be honest with you, but not terrible either, showing that the consumer was weakening, but overall fine. More of a reversion to the mean post-pandemic. So no issues there, but as we go along in this earnings season, that could be a catalyst for one way or the other. Commodities continue to be relatively subdued, although oil, is starting to get some traction at the upside, but not big traction. So I don't see a ton of upside for oil in the near term. What did well this week? Industrials had a little bit of a rebound, but that is pulling back. Growth definitely had a strong week. So that's something I'll be watching. Here's the growth to value. Right. So that did rally pretty strong this week. And is that because of more easing? It's hard to tell, but we'll see if we can get some traction above this 50-day moving average. That's what I'll be watching. Right. We got that rally. You get these often where there's strong rallies in growth over value, and then it rolls over. You saw that back in 2020. And I think this year will be a lot more like, 2022, a lot more like 2022, where you get those rallies, strong rallies, and then a rollover. Strong rallies, and then a rollover. Last year, you got consistent rallies and staying above the 50 and the 100-day moving average for most of this time period. Now we are below the 50 and the 100. This is starting to create a trend, although this is threatening for that downtrend to switch over. And that would mean growth would outperform value. So I'll be certainly watching that. But it was 1 week, not something that should change your mind about that trend as of now. One thing I was watching too is ARK. ARK funds, bad. Right, and it's another indicator to me that this counter trend rally, let's go to a weekly chart. ARK did terrible in 2021, 2022 basically. Right, this is where the downtrend really started in the fall of 2022. And it rallied for pretty much all of 2023. But it was a weak rally, and now it looks like it's starting to roll over. So that's why I say I think the trends within the markets are going to be more similar to 2022 than 2023. Kind of the underlying trend of the market. I don't think it's going to be as weak generally as 2022. But in fact, I actually think asset prices will be higher, but with a different kind of tenor than you saw last year. So that's my take. What else I want to get to? Let's just look at the broader. Let's look at IWV. IWV, that's the Russell 3000, so the 3,000 largest companies. A bit sell-off in the start of the year and a bit of a rally, and we're about flat on the year for broad equities. So, a choppy January is not surprising to me. It kind of, came to the year overbought. And it would not shock me to see, how January goes is typically how the year goes. So they say, is the market up? Is the market down? I expect this month to be kind of choppy and relatively flat. And we're almost halfway through. In fact, we are halfway through because Monday is a holiday and there's no trading there, and that's the 15th. So we're halfway through the month and equity prices are flat. And I think that's the likely scenario for January. The 10-year did pull back a little bit this week, right about the 4% rate. I actually think we're kind of going to start a trading range between, say, 4.5 and 3.5 on the 10-year. Until there's some resolution to inflation, to Fed policy, how aggressive are they to rein in an increase in rates? And does inflation reaccelerate in the back half of the year. And I think that is my base case. Is that's where the Fed gets into a little more of a bind if inflation does reaccelerate, with maybe the economy continuing to slide into recession. I think that's possible as well. So something I'll be watching for. But near term, you have to be bullish on asset prices. Credit markets aren't blowing up. The treasury market isn't blowing up. Governments are still spending, and GDP is growing, which means earnings are growing. And in fact, for the fourth quarter, earnings are expected to be up. And for this year, earnings are expected to be up about 10%, 10, 12% for the year. Now, I don't expect that to come to fruition throughout the full year. Probably only be a modest increase in earnings on the year, but modest increase, I think, will keep the market chugging along. But probably a more volatile year ahead than last year. Well, I think that about does it. Appreciate you all tuning into this channel, liking and subscribing. A reminder that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KP Financial and those associated. Have a wonderful weekend.